So a seemingly invisible, 1% fee on a $3 million portfolio really won't make headlines. But over 20 years, it will quietly erase over $500,000 of your wealth.
Oh, yeah.
I mean, that is an entire vacation home, right? Or a fully funded generation of college tuition, or just a decade of retirement travel just vanishing into thin
Yeah,
air.
staggering amount of capital when you actually map out the math.
Mm-hmm.
And the terrifying part is that it happens completely silently in the background.
Exactly. It's not a market crash that you see on the evening news. It's like slow leak in the pipes. And that brings us to the core of what we're unpacking today.
Right, our deep dive.
Yeah, we have a massive deep dive ahead of us. We're basing this on a really comprehensive guide provided by Thomas Davies of Davies Wealth Management. They're a fee-based fiduciary advisor located in Stuart, Florida. And this material was originally put together for the 1715 Treasure Coast Financial Wellness podcast.
And, our mission for this deep dive is to extract the critical warning signs from that material. We're looking at a 12-point due diligence framework to help you spot the structural, strategic, and relational red flags in financial advisory relationships.
Which is so important.
Right. And we are focusing heavily on high net worth individuals today. These are the people who have the absolute most to lose from generic, cookie cutter or just fundamentally conflicted advice.
For sure. But before we get into those specific warning signs, let's establish why the rules of the game fundamentally shift at a certain level.
Good point.
The source material makes a very sharp distinction here. Because having, say, $50,000 to invest is one thing. But when your investable assets cross that $1 million, $5 million, or $10 million mark, scale changes everything, doesn't it?
It completely rewrites the playbook. I mean, the guide draws a very clear line between mass market advice and high net worth advice.
Right.
If you look at mass market financial planning, the focus is largely on standard tax deductions, maybe getting a basic term life insurance policy in place, and picking an allocation from a set menu of, maybe 5 to 10 model portfolios.
Which, to be fair, gets the job done when you're just starting to build a nest egg.
Oh, absolutely.
But the analogy that kept popping into my head while reading this was about cars. Taking a multi-million-dollar, highly complex portfolio to a mass market advisor is essentially like taking a high-performance sports car to your neighborhood lawnmower mechanic.
Oh, that's perfect.
Right. It's not that the mechanic is bad at their job. They just do not have the specialized diagnostic tools or the deep engineering knowledge required to fine-tune a complex V8 engine.
That is a perfect framework for this. Because when the mass market mechanic messes up the sports car, the financial stakes are, they're exponentially higher.
Yeah.
Take estate taxes, for example. The source highlights some critical 2026 data regarding the federal state tax exemption. In 2026, that exemption drops to $13.99 million per individual.
Now, that sounds like a massive number to most people, though. Like, why should they worry?
It is a big number, but for an affluent family who has owned a business or, say, real estate for decades, crossing that threshold is actually very common. And once you cross it, every single dollar above that line gets hit with a 40% federal estate tax.
Wow. 40%.
40%. So if you're sitting across from an advisor who only knows how to offer generic retirement advice and they completely ignore your estate tax exposure, that isn't just a minor oversight. That is financially catastrophic for your heirs.
Okay, yeah, the stakes are undeniably huge. So let's look at how the actual legal structure of an advisor's business might be, quietly working against you.
Structural trap.
Exactly. The guide dives deep into what I like to call the structural traps. And it starts with the most critical distinction in finance, the fiduciary standard versus the suitability standard.
This is really the bedrock of the entire relationship. A true fiduciary is legally obligated to act in your absolute best interest above their own 100% of the time. Full stop.
Right. But the majority of the financial industry operates under what is called a suitability standard. That means a broker only has to recommend a product that is generally suitable for your age and risk tolerance, even if a significantly cheaper or better alternative exists somewhere else.
Let me play devil's advocate here for a second, though.
Sure.
If a non-fiduciary broker pitches me an in-house mutual fund that returns 12%, and a strict fiduciary puts me in an index fund that returns 8%, why should I care about their legal title? Isn't bottom line performance all that actually matters?
It's a fair question, but it ignores how risk and fee drag work behind the scenes. That 12% return being pitched by the broker usually comes with massive hidden risk parameters or severe liquidity lockups that they, frankly, aren't incentivized to highlight.
Oh, I see.
Plus, if they're making a massive commission on that product, they're structurally incentivized to keep you in it, even when market conditions change and it's no longer the best option for your portfolio, which brings up this incredibly sneaky middle ground the source material warns about: dual registration. I mean, how does someone be a fiduciary and a broker at the same time?
Through a legal loophole where they basically just switch hats depending on the minute of the meeting.
Wait, really?
Yeah, an advisor with dual registration can act as a fiduciary while they're sketching out your general retirement plan. But then, in the exact same meeting, they can legally drop down to that lower suitability standard when it's time to actually sell you the specific investments to fund that plan.
I am still blown away that this is legal. I mean, to me, that sounds exactly like a doctor pausing your annual physical, putting down the stethoscope, and suddenly acting as a pharmaceutical sales rep who earns a commission on the prescription they're writing for you.
That's exactly what it's like.
You would walk out of the clinic, so why on earth would you accept that with your life saving?
You absolutely shouldn't, and that's why the guide is so adamant. You have to look your advisor in the eye and ask, are you a fiduciary 100% of the time in writing?
In writing, that's the key.
Yes. Because if they dodge the question or say something like, oh, we always strive to do what's best for our clients without putting it on paper, you need to walk away.
So if a dual-registered advisor is legally allowed to put their firm's interests ahead of yours, how exactly does that manifest in your portfolio?
Well, the guide suggests it usually starts bleeding out through the fee structure.
The layers of hidden fees.
Exactly. When an affluent investor looks at their statement, they usually just see the top-line advisory fee, which might be around 1%. But the real wealth of destruction happens underneath the surface. You have underlying fund expense ratios, which can add another 0.20 to 1.50%. Then you have something called 12b-1 fees.
Okay, I have to stop you there because 12b-1 fees infuriate me.
Oh, I know.
Can you explain to the listener what they're actually paying for when they get hit with a 12b-1 fee?
It is essentially a marketing and distribution fee embedded directly into the mutual fund. You are quite literally paying the mutual fund company so they can afford to market and sell that exact same fund to other people.
Which is just wild.
Yeah, it does absolutely nothing to improve your investment return.
And then the guide mentions surrender charges on annuities, which is basically a fee for wanting your own money back. The math they lay out is incredibly sobering.
It really is.
On a $5 million portfolio, the difference between paying a total all-in cost of 0.80% versus a bloated 2.0% is $60,000 a year.
And that $60,000 compounds. It isn't just a one-time bill, right? It is a structural leak, draining the oxygen out of your compound interest over decades.
Which ties right into the danger of proprietary products. The guide warns against advisors who constantly push their own in-house funds or alternative investments. I mean, if I'm an advisor, why am I so desperate to put my client in a fund with my own company's logo on it?
Because it allows the firm to double dip.
Of course it does.
If a massive brokerage firm puts you in their own internal mutual fund, they're collecting the advisory fee from you at the top level, and they are sweeping the internal expense ratio of the fund at the bottom level. A genuine independent fiduciary is completely agnostic about whose logo is on the prospectus.
They just want what works.
Right. They scan the entire global market to find the most cost-effective, precise tool for your specific situation.
Okay, so we've mapped out the structural traps, how the advisor is legally bound to you, and how they get paid. Let's shift gears and look at what they actually do with the money, the strategies.
Let's do it.
Because for high net worth families, the guide makes it clear that failing to do proactive tax planning is a massive dereliction of duty.
Yeah, the author makes a brilliant definitive statement here. For affluent families, tax planning is wealth management. They are not two separate disciplines. If your advisor is only looking at your investment returns and ignoring the tax bracket those returns sit in, they are only doing half the job.
The guide gives a very mechanical example of this regarding Roth conversions. Walk us through how a missed Roth conversion actually costs someone money.
So let's visualize a couple with $4 million locked in a traditional pre-tax IRA. When they eventually take that money out in retirement, every dollar is taxed as ordinary income.
Right.
Now, let's say there is a year where they retire, but haven't started taking Social Security yet, so their actual reported income is unusually low.
Yeah.
They are in a very low tax bracket for a brief window.
A perfect opportunity.
Exactly. A proactive advisor will aggressively convert portions of that traditional IRA into a Roth IRA during that low-income year. They pay a little bit of tax now at, say, the 24% rate.
And if they miss it?
If the advisor is asleep at the wheel and misses that window, the couple will eventually be forced to take required minimum distributions later in life when their income is much higher. That forces that same money to be taxed at, say, 37%. The guide estimates this simple lack of foresight can cost a wealthy family over $500,000 in completely avoidable lifetime taxes.
At $500,000, just because the advisor didn't want to coordinate with the CPA.
Yep.
And it doesn't stop at income tax either. The guide also brings up IRMAA surcharges. For those who haven't had the joy of encountering this yet, IRMAA stands for Income-Related Monthly Adjustment Amount. It's basically a hidden cliff penalty on your Medicare premiums.
Precisely. And the thresholds are surprisingly low for affluent retirees. In 2026, those surcharges kick in at a modified adjusted gross income of just $106,000 for a single filer or $212,000 for a joint filer.
So what happens if an advisor accidentally trips that wire?
Well, let's say your advisor carelessly decides to rebalance your portfolio in December and triggers a massive capital gain. Or they take a poorly timed IRA distribution that pushes your income just $1 over that IRMAA threshold.
Just $1.
Just $1. You don't just pay tax on that dollar. You are suddenly hit with a surcharge that could add thousands of dollars to your Medicare premiums for the entire year. If your wealth manager is operating in a silo away from your tax planning, you are the one paying the penalty.
Man, this highlights why the one-size-fits-all model is just so dangerous. If I have a $3 million account, the internal plumbing of that account should not look identical to my neighbor's $100,000 account.
Not at all. A mass market model heavily relies on generic mutual funds and basic bond funds. But at a higher net worth, the tools have to evolve. For example, instead of a bond fund, a high net worth portfolio should be utilizing individual bond ladders.
Okay, wait, why is an individual bond better than a bond fund? I mean, they both just hold bonds, don't they?
They do, but it is about control and tax loss harvesting. Wow. In a bond fund, you own a slice of a massive, constantly shifting pool of bonds. If interest rates rise and bond prices fall, the fund loses value, and you just suffer the paper loss.
You're just stuck with it.
Right. But if you hold individual bonds, and a specific municipal bond drops in value due to rate shifts, your advisor can proactively sell that specific bond, capture the tax loss to offset capital gains you made in the stock market, and immediately buy a similar bond to keep your income stream intact. You just cannot execute precision tax loss harvesting inside a generic mutual fund.
That makes total sense. It's like you have the steering wheel instead of just sitting in the passenger seat.
Exactly.
The guide also mentions that cookie-cutter models completely fail when it comes to concentrated stock. Let's say I'm an executive and I have $2 million locked up in my employer's stock. I can't just sell it all tomorrow without getting crushed by capital gains taxes. The text mentions exchange funds. For someone who hasn't dealt with this, what exactly is an exchange fund doing behind the scenes?
Oh, it is a brilliant mechanism for the wealthy. Basically, an exchange fund allows you to take your highly concentrated stock, say your $2 million in Apple, and pool it together with dozens of other executives who have concentrated positions in Microsoft, Amazon, or Google.
Okay, so you mix it all together.
Yeah, you contribute your single stock into the partnership, and in return, you get a proportional share of the entire diversified pool.
And because it's a partnership swap, you don't trigger a taxable sale.
Exactly. You achieve instant diversification without realizing a massive capital gain. A neighborhood mass market advisor doesn't even have access to these types of institutional tools, let alone the expertise to implement them.
Wow. Speaking of things a good advisor should do, the guide spends significant time on the necessity of an investment policy statement, or an IPS. It argues that a verbal financial plan is essentially a myth.
Because human memory is inherently flawed, especially when money and emotion are involved. An IPS is a formal written document that dictates your exact target asset allocation, the specific triggers for when the portfolio will be rebalanced, and the benchmarks used to measure success.
So an IPS is essentially the blueprints for a house.
Yeah.
You would never let a contractor just start pouring concrete and running plumbing based on a casual conversation you had over a round of golf. You need a schematic to hold them accountable.
That is exactly what it is. Without an IPS, there is zero accountability. An advisor can just shift the goalpost whenever the market underperforms.
That's a great point.
And an IPS also protects you from yourself. When the market drops 20% and you panic and call your advisor demanding to sell everything to cash, the advisor pulls out the IPS that you signed in a calm state of mind and uses it to coach you back off the ledge.
But to get that coaching, you need an advisor who speaks plainly. The guide calls out weaponized jargon as a major red flag, stating that complexity is not sophistication.
Financial jargon is incredibly effective as a smokescreen. If your advisor cannot explain the core mechanics of your portfolio in plain English, they're likely using complexity to intimidate you.
Right.
If they make you feel foolish for asking questions, you will stop asking questions. And that is exactly when fees get hiked and underperformance gets hidden.
Which transitions us perfectly into the human element. The final set of warning signs revolves around the relationship itself. The guide points out that hiding credentials or getting defensive when a client asks for a second opinion is a massive behavioral red flag.
It stems from ego and structural insecurity. Confident professionals welcome scrutiny because it validates their work.
Yeah, Davies Wealth Management actually notes that they actively provide second opinions on existing portfolios as a core part of their practice.
Which is exactly what you want to see. A truly skilled advisor is never threatened by you comparing their strategy to someone else's because they know the tangible value they bring to the table. If your advisor acts insulted when you ask for their SEC filings or want to verify their background, you have to ask yourself what they're trying to keep hidden.
And then there is the danger of the solo practitioner. The guide flags advisors who have no succession plan. Let me push back on this, though, because I know people who absolutely love their solo advisor. They've golfed with them for a decade. Their kids know each other. They trust them implicitly. Why is being a solo practitioner inherently a bad thing?
Well, because you're ignoring catastrophic structural risk.
Yeah.
You might love them and they might be a genius, but what happens if they suffer a severe stroke tomorrow? Or they get into a car accident?
The music stops.
Completely.
Yeah.
When you are dealing with multi-generational wealth, complex family trusts, and intricate tax strategies that require constant monitoring, you cannot afford a single point of failure.
Right.
If there is no documented continuity plan or no team cross-trained on your specific estate nuances, your family's entire financial framework freezes the moment that solo advisor becomes incapacitated. It is an unacceptable level of risk for high net worth families.
That is a very sobering reality check. So we've spent a lot of time mapping out the minefield.
Let's pivot to the green flags. If we're doing our due diligence, what exactly should we be looking for?
The green flags are essentially the inverse of the structural traps we opened with. You want a firm that operates as a fiduciary 100% of the time and puts it in writing. You want transparent fee schedules that include breakpoints.
Breakpoints meaning as your total wealth grows, the actual percentage fee you pay scales down.
Exactly. You also want a collaborative, team-based approach for continuity, and you want an advisor who actively insists on coordinating with your CPA and your estate attorney.
And the value of finding this kind of holistic advisor isn't just about avoiding the hidden fees, right? It's about generating measurable net positive gains. The source material reference is a fascinating metric from Vanguard's Advisor Alpha framework. They quantify that a highly skilled advisor can actually add about 3% in net returns per year. But you mentioned earlier it's not from picking the next hot stock. Right, stock picking is a fool's errand. The 3% alpha comes from structural optimization. It comes from behavioral coaching, preventing you from selling at the bottom.
Makes sense.
It comes from asset location, which means knowing whether to place a high-yield, tax-inefficient bond inside your Roth IRA versus your taxable account. And crucially, it comes from withdrawal sequencing.
How does withdrawal sequencing work? I imagine it's like harvesting crops. You don't just pull from random fields.
Exactly. When you retire, you have buckets of money. Taxable brokerage accounts, tax-deferred IRAs, and tax-free Roth accounts. A skilled advisor calculates exactly which bucket to pull from each year based on your current tax bracket, current market valuations, and future legislative risks.
Oh, wow.
Yeah, pulling from the wrong bucket in the wrong year can trigger IRMAA penalties and spike your income tax. Managing that sequence properly is where the 3% alpha is generated.
So how do we verify if an advisor actually has the chops to do this? The guide offers a brilliant, actionable tool. Form ADV Part 2A.
The brochure. Every registered investment advisor is legally required by the SEC to file this document. It is a goldmine of transparency. It legally forces them to disclose their exact fee schedules, any disciplinary history, every conflict of interest, and This is the ultimate sniff test, the typical size of their client accounts.
That is the secret weapon. Because if you have a $5 million portfolio and you are sitting in a fancy mahogany office, but you look at their ADV and see their average client only has $200,000, well, the illusion drops. You instantly know they do not possess the high net worth expertise your family needs. They are playing a different sport entirely.
It is the ultimate lie detector test. It empowers you to verify what the advisor is promising in the pitch meeting against what they have legally sworn to the federal government.
So, to bring all of this together, managing significant wealth requires so much more than just a passing interest in the stock market. It requires a transparent fiduciary quarterback, someone who genuinely understands the deep interfere with your actual life.
It requires a professional who is managing the entire chessboard, anticipating moves years in advance rather than just reacting to the daily news cycle.
And your call to action for you listening right now is to take these exact questions into your next annual review. Look your advisor in the eye and ask them to confirm their fiduciary status in writing. Ask them to walk you through your investment policy statement. Ask about their succession plan and demand to see their Form ADV Part 2A.
And if I can leave you with one final, slightly provocative thought to mull over.
Please do.
We talked a lot today about the suitability standard and how non-fiduciary brokers are legally allowed to recommend products that aren't the absolute best for you. It makes you wonder, if the wealth management industry has spent decades and millions of dollars in lobbying, fighting incredibly hard to maintain the legal right to give you suitable advice rather than fiduciary advice, what does that tell us about where their actual profit margins come from?
That is a phenomenal question to end on, because if you aren't asking these hard questions, that silent 1% leak is going to keep running, and it might just swallow that vacation home you've been dreaming of before you even realize it's gone.